Be Your Own CFO, Part 17. Let's talk about cost of goods sold. What is it? Pretty self-explanatory. It's a cost of the units sold to generate the revenue that was recorded during that time period. Most common approach to track this number is to multiply the number of units shipped times the cost of each unit. Determining the correct cost for each unit can actually get quite complicated, so we're going to cover that much later. But for now, we'll cover the four main costing methodologies. You've got LIFO, FIFO, average cost, and specific costing. FIFO is first in, first out, which means that when you determine your cost of goods sold, the first batch that was purchased is the first batch to be sold. So for example, let's say I bought a batch of 100 units at $10 each, and then a second batch of 100 units at $15 each. If I sold 2 units, it would come from the first batch first. So 2 units, $10 each, $20. LIFO is last in, first out, which is basically the opposite, meaning the last units purchased are the first ones sold. Average costing just means that the costs are averaged out across all the purchases. Under average costing, we blend the cost of the 2 batches, so you get 200 units for $12.50 each, so if you sold 2, it's for $25. And under specific costing, every unit sold has its own cost. That's a lot more common if everything you build is custom. The right method to choose is a balance between reflecting accuracy and ease of use. Next up, we'll talk about gross profit and gross margin.